Good morning, everyone. Welcome you all to today's webinar on capitalization in banking and financial institution. It's a topic that is core to the stability of overall financial system. I am Vishal Pujari, Senior Rating Analyst at Brickworks Rating, and I'll be presenting this session. Joining me today, Mr. Hemant Sagare, Director of BFSI at Brickworks Rating, who will be adding his perspective during the discussion and question and answer. Before we dive into our discussion, let me briefly introduce Brickworks Rating. We are one of India's leading credit rating agency, accredited by RBI and recognized by SEBI. We provide independent and credible credit ratings, research, and risk assessment service across wide spectrum of industry, including banking, financial service, infrastructure, and corporate sectors. In an increasingly uncertain economic and regulatory environment, capitalization has emerged as a critical driver of financial stability and sustainable growth for banks and financial institutions. In this webinar, we'll understand various aspects of capitalization, covering its role in the overall financial world and what are the best practices of maintaining sufficient capitalization. We'll also discuss on the regulatory framework governing capitalization. Now let's get started. Can you move to slide number 3, please? Here we have discussed what is the meaning of capitalization and the roles in mitigating various risks. Now, the capitalization refers to the amount of capital a bank or FIs hold related to its asset and risk as a buffer against potential losses. When credit loss rises, market turn volatile, or liquidity tightens, capital ensure that these banks, this risk do not translate into solvency issue. Institutions with strong capital are able to absorb stress, maintain operation, and retain stakeholders' confidence. It also helps in building trust with depositors and regulators even in adverse events. Now let's understand what capitalization can do in mitigating various risks like credit, operational, market, and liquidity that arise during the business operation. In the context of credit risk, capital acts as a buffer against loan losses and rising non-performing assets, that is NPA. It also helps in protecting both lenders and depositors during this kind of scenario and enable institutions to absorb sectoral and borrower-specific stress. Now, with respect to market risk, strong capital absorb losses arising from adverse movement in interest rates, equity prices, and foreign exchange rates. It also helps limiting capital erosion during periods of market volatility, ensuring balance sheet stability during sharp market correction. Now, in terms of operational risk, there is a third risk. Capitalization helps in covering losses from fraud, system failures, cyber incidents, and process lapses. Adequate capital supports investment in establishing robust system, governance, and controls, enhancing banks and FIs' resilience against unexpected operational shocks. Finally, strong capitalization also helps in reducing liquidity risk by improving market confidence and access to funding. It enables the institution to raise funds even under stress conditions and acts as a backstop when liquidity buffers are tested, thereby reducing refinancing and rollover risk during liquidity stress. So, in summary, you can say well-capitalized institutions have greater flexibility during the economic downturns. They can manage liquidity pressure, absorb shocks, and continue operation without requiring government assistance. Hence, capitalization ensures overall financial stability and solvency. Now, for credit rating agency, capitalization is an important parameter in assessing financial institution strength. Now that we have learned how capitalization strengthens banks and FIs by mitigating various risks, we'll now turn our attention to examine the circumstances under which these risks emerge, which can create financial instability. In slide number 4, we have discussed what is the undercapitalization and overcapitalization. Also, we have mentioned regarding optimum capitalization that we'll discuss in the same slide only. Now, the risk arises when capital base of a bank and FIs is insufficient relative to the level of risk it undertakes. The situation is called as undercapitalization. It can create insolvency risk also, as inadequate capital limits the bank's or FI's ability to absorb losses. It also leads to heightened regulatory intervention because it can breach RBI capital adequacy norms. In addition to this, liquidity risk also emerges due to weakening depositor confidence, potentially resulting in deposit withdrawals. Now, the cause of undercapitalization includes rising NPA level, which can erode net worth. weak risk management, or weak credit appraisal practices. And also, when there is an aggressive unsecured lending without corresponding capital augmentation, undercapitalization happen. Now, such conditions are often negatively viewed by credit rating agency. Therefore, it is very much important and critical for banks and FIs to maintain at least the minimum capital level prescribed by RBI guidelines. Now, we had some example in the recent past. The crisis happened related to undercapitalization. One of the private sector banks during 2020 had faced crisis due to the erosion of capital caused by rising NPA level with aggressive corporate lending and also due to poor risk management, which resulted in RBI intervention, moratorium imposed, and finally there is a capital infusion led by SBI and other banks. What is the impact? Weakening of investor confidence. Now, as we discussed undercapitalization, now let's turn to overcapitalization. Conversely, overcapitalization refers to a situation where financial institutions hold capital significantly in excess of what is required in the risk profile and business operation. It leads to inefficient deployment of funds. While capital adequacy may appear strong in this case, profitability can be adversely affected, as reflected in the lower return on equity, as excess capital is not fully deployed to generate proportionate returns. Overcapitalization can also cause from the limited lending and investment opportunity, while excessive equity issuances, which result in surplus capital remaining underutilized instead of being deployed into productive assets. Now, for NBFC, however, excess capital can provide flexibility to support expansion, absorb volatility, and meet evolving regulatory requirements. However, prolonged overcapitalization may still impact the return matrices like ROE, return on equity, if surplus capital remains underutilized. Therefore, while overcapitalization doesn't typically pose a systematic risk for NBFC, the effective capital deployment remains important for balancing growth and profitability. So we can say the key challenges for banks and FIs is to strike an optimal balance, maintaining sufficient capital to absorb shocks without constraining growth. The situation is called optimal capitalization, that is the ideal state, wherein capital is maintained slightly above regulatory minimum along with internal risk buffer, enabling sustainable growth while ensuring a sound and resilient financial system. Now, in the slide number 5, we can see what are the components of capital and what is the key capitalization matrix. That means what is the measurement method banks and FI use to know their capitalization level. The total capital of bank or FI includes tier 1 and tier 2 capital. This capital is also called as regulatory capital. Let's understand what is tier 1 capital. That is the core capital of a bank and FIs. This forms the strongest and most important layer under the Basel regulatory framework. This is designed to absorb losses while the bank continues operating as a going concern. Hence, it is also called as going concern capital. It consists of two major components, CET1, that is Common Equity Tier 1 capital, and additional Tier 1. Let's focus on CET1. It is the highest quality of capital that a bank and FI holds. It includes common equity shares, share premium, retained earnings, accumulated other comprehensive income. Now, since this capital is fully available to absorb losses immediately without disrupting day-to-day operation, it is regarded as the strongest capital buffer by investor, regulators, and also depositors. Now, what is AT1, additional Tier 1 capital? This is another financial instrument which supports CET1 capital to strengthen the overall Tier 1 capital. It includes perpetual non-cumulative preferential, perpetual subordinated debt instruments, and share premium associated with AT1 instrument. Now, another component of capital is Tier 2, that is a supplementary capital. It provides an additional layer of protection but only absorb losses after the liquidation of banks. It typically includes subordinated debt, revaluation reserves, hybrid capital instrument, and loan loss reserves. Now, since Tier 2 comes into play once the bank is liquidated, it is considered as gone concern capital. This means it absorbs losses after Tier 1 capital has been exhausted. So, to summarize this, a bank's total regulatory capital means total capital is combination of Tier 1 capital and Tier 2 capital. Tier 1 capital is the highest quality, most loss absorbing capital designed to keep the bank operating smoothly despite negative events. And whereas Tier 2 capital absorb losses only in the event of failure or liquidation. Now, let's try to focus on the key capitalization metrics. The key measure for capitalization of a bank and FIs, which is used globally and mandated by RBI, is the capital adequacy ratio, also known as CRAR, that is capital to risk weighted asset ratio. Capital adequacy refers to how much capital a financial institution holds relative to its risk weighted asset. The, so CRAR means capital to risk weighted asset ratio, whereas the capital is tier 1 and tier 2. Now let's discuss the denominator part of CRAR, that is risk weighted ratio, that is RWA. It represents a bank's asset weight according to their in the risk pattern, like credit risk, market risk, operational risk. Now each asset is assigned a risk weight based on the perceived risk, as discussed, both all the three risks. So if you have cash and government security as an asset, the risk weight will be 0%. Where you have asset like highly rated banks or security secured exposure, then the weight should be 20 to 50%. And if you have some risky asset like retail loans and corporate loans, the risk weight will increase to 75 to 100%. And after that, if you have NPA or highly risky unsecured exposure, then it will be more than 100%. So the value of each exposure is multiplied by its risk weight, which arrive as total risk weighted asset. Now, this capital adequacy ratio reflects a bank's resilience to financial stress and constitute a key regulatory requirement under the Basel framework and RBI guidelines. While it is important to understand the various components that we have discussed and associated capital ratio, it is equally critical to be aware of the regulatory threshold. Now come to slide number 6. Here we have mentioned all the regulatory ratio under the Basel framework. As as you know, the capital ratios are prescribed and periodically updated by RBI in alignment with Basel norms. All banks, both public and private, as well as NBFCs, are required to comply with this RBI mandated requirement. Banks are required to maintain a minimum capital to risk weighted asset ratio of 11.5%. This comprises base capital requirement of 9% along with an additional capital conservation buffer of 2.5. So total is 11.5. And the other key capital ratio like tier 1 ratio are subject to similar RBI specified thresholds as outlined in the table. Now for NBFC, however, the minimum requirement of CRAR is 15%. Why there is a difference? Because if the difference is based, why there is a difference of banks and NBFC capital requirement? The difference is based on their business models, risk profile, and regulatory frameworks. In summary, all financial institutions, whether banks or NBFC, under the RBI regulatory framework, must adhere to this capitalization requirement. These norms serve as a critical safeguard during period of financial stress, thereby reinforcing the stability and resilience of the financial system. Now we'll see in the next slide what are the trends of capitalization across banks. Here we briefly review the capitalization trends across different category of banks. As of March 25, you can see Scheduled Commercial Bank, that is SCB, reported an improved CRAR ratio of 17.3%, while Public Sector Bank, PSB, recorded a CRAR of 16.1% in FY25. Now, the highest portion is measured by foreign banks that had CRAR ratio of 18.6% in FY25. Here, all category of banks, SCB, FB, private and public banks, improved their CRAR from September 2024 position due to higher capital growth as compared to RWA growth. A similar trend is observed in CET1 ratio. That below this chart, we have CET1 ratio with foreign banks leading, followed by private sector bank, sorry, and Scheduled Commercial Bank. Now, in the next slide, slide number 8, we can see the trends of NBFC. Since NBFC had different layer like mid layer, upper layer, and base layer, we can see here we can see only the mid layer and upper layer comparison. Base layer, why you can see, because there is no capital requirement for a base layer NBFC. So we can see this base layer is for NBFC whose asset size is below 1000 crore. So we can see here the total CRAR of mid layer and upper layer of NBFC was very healthy at 25.8%, indicating strong capital position as of 25. So overall in FY25, all banks and FI performed well in terms of capitalization, which is a good sign for the financial sector, and it should be maintained. Now, in the next slide, slide number 9, we have discussed the role of credit rating agency and how they assess the capitalization of financial institution. The first point what they assess is the capital strength. Banks and FIs should meet minimum capital requirement. That is the first and foremost condition by RBI. And also an important determinant of capital strength is riskiness of their asset portfolio relative to their assets, commonly measured through risk-weighted asset density, or that is called RWA density. A higher RWA density indicates a riskier asset mix, such as unsecured loan, corporate credit, or lower rated exposure, which require more capital to cover this riskiness. However, lower RWA density reflects safer portfolios such as government security and highly rated assets. So this is critical for CRA to assess this. Now, second point is whether they have any government support. Not only the public sector banks, private sector banks and NBFC, if they have any government support or parent support who can infuse capital in case of requirement, the situation happens. So we can see, we'll see the government support. If there is a government support, then the capitalization will not be a worry for CRA. Third is relative franchisee strength and competitive rating. The CRA will look for market size of banks and NBFC. What is the market size? How is the stability of their financial condition, their customer base, their deposit franchisee, and regarding diversification of business. These strength of banks or FIs make them better placed for generating capital internally and also to raise external capital during stress. Another thing, important thing is what is the outcome of stress test by RBI. Credit rating agency also look at macro stress test outcomes to evaluate capital resilience, the downside risk and likelihood of external support. Now, as per RBI Financial Stability Report published in June 25, the result of this test of 46 major SCB affirmed that most SCB have adequate capital buffers relative to their regulatory minimum, even under adverse scenario. Also, NBFC remain healthy with sizable capital buffers. Report also says that there may be a marginal dip of 20 basis point in CRAR ratio for SCB in March 27 under the baseline scenario. Baseline is assumes normal economic condition. However, it may decline to 14.2% scenario 1, that is geopolitical risk scenario, and with another adverse scenario 2, which assume global growth slowdown scenario. CRAR ratio may decline to 14.6% under this. However, overall, none of the banks would fall short of regulatory minimum requirement of 9%, that is base minimum requirement, even under adverse scenario as per the RBI report. These findings underscore the strong loss absorbing capacity and resilience of Indian banks and NBFC. Now, in the next slide, slide number 10, we have discussed the capital adequacy of for an NBFC and what it is, how it is important. Capitalization for an NBFC refers to the adequacy and quality of capital available to absorb losses. Unlike banks, NBFC do not accept demand deposits and therefore rely more heavily on market borrowings, making capitalization a critical pillar for financial stability and creditworthiness for NBFC. Now, for NBFCs, capitalization, their funding profile, and the liquidity buffers are closely interlinked and together determine the institution's ability to withstand stress, maintain solvency, and meet obligation. Credit rating agency assess these factors holistically, not rather than in isolation. Now, what we seek as a credit rating agency, we see the funding mix and what is the diversity of funding, their share of short-term market borrowings, their liquidity buffers, That is very important. Whether they have liquid asset, liquid investment, and most important point is high dependency on wholesale funding. Wholesale funding is borrowing from institutional investors. These funds are typically short to medium term, market linked in pricing, and sensitive to credit ratings and market confidence. So we had one recent example of ILNFS where heavy reliance on short-term wholesale funding with combination of with weak liquidity buffers had a default scenario. So in summary, higher reliance on wholesale funding demands stronger liquidity buffers. That we have to that as a CRA we need to see all the points. That is the role of CRA. Now in next slide we had we focused on what impact weak capital adequacy and strong capital adequacy have on the credit and in the ratings. Now, rating agency focus on the quality of capital, also not merely the numbers. The concern arises when capital is supported by excessive tier 2 instrument. There is a high leverage situation also. Also, capital is if when capital is dependent on frequent external infusion, and also internal capital generation is weak due to low profitability. These are the situation where concern rises. Now, what triggered a downgrade? A downgrade triggered by weak capital adequacy, uh, which can lead to higher borrowing cost, reduced investor appetite, tighter covenants from lenders, increased regulatory scrutiny, and pressure on profitability and liquidity. However, rating agency views positively in this kind of situation where NBFC have higher proportion of core equity capital, strong internal capital generation that I have discussed in the previous slide, limited reliance on short-term and hybrid instrument, and conservative leverage and risk appetite. So, in short, high quality capital strengthen confidence in the reported capital ratios. Now, in the following slides, we have discussed 11 and 12 here. What is the impact of strong and weak capital adequacy? Now, in the following slide, slide number 13, we can see what is the outlook of capitalization and what are the best practices to have an optimal capitalization. Now, we'll see the outlook segment wise. Regarding banks, Indian banks, what is the current capital position? The Indian banking system today are very well capitalized, as we discussed in the earlier slide on the capitalization trends. As per RBI stress test scenario, also nothing. There is no such worry trends. Most banks maintain CRAR well above RBI minimum requirement. CET1 ratio are very comfortable, providing headroom for growth. Also, they have strong profitability and lower NPS that has strengthened internal capital generation. Now, if you see public sector and private sector banks, capital position of public sector bank have materially improved due to government infusions, sharp reduction in NPA, and return to profitability. Now, but and PSB are now better placed to support infrastructure and capex-led credit growth, meet regulatory buffers without frequent recapitalization. Whereas private sector banks, they have strong capital buffers because they have focused on more on capital efficiency, risk-weighted asset optimization, and managing high growth in retail and unsecured lending. But the risk remains when there is a rapid expansion in unsecured personal loans, which could increase capital consumption. Now, what about small finance banks and new banks? Their capital levels are adequate, but there is a growth heavy models which consume capital quickly, and also they have limited access to low cost equity. Now, let's focus on the NBFC. What is their outlook and what is the current landscape? The capitalization outlook for NBFC is divergent and selective. Large, well-rated NBFC they have comfortable capitalized, whereas smaller and mid-layer NBFC face structural capital pressure. Capital has become more expensive and more discriminating for them. Now, in the NBFC also we have large, medium size, and small NBFC. Let's look one by one. What is the large and systematically important NBFC? For them, they maintain healthy capital buffer. They have better access to equity markets, bank funding. Also, they have improved governance and risk management. For mid-size NBFC, Capital stress driven by higher cost of funds, concentrated loan portfolio, and rising compliance and regulatory cost. However, for small NBFC, they have limited access to equity, high dependence on wholesale funding, vulnerability to liquidity and asset quality shocks. Now, let's understand the best practices uh, for financial institutions to have an optimum capital level to avoid all those above risks that I have mentioned. What they can do to have an ideal state of capital level. So, first and foremost thing is, as I've already mentioned, maintain a capital above regulatory requirement. Banks and financial institutions should always operate with capital levels comfortably above the minimum regulatory requirement to ensure resilience against or unforeseen shocks. Apart from that, they need to focus on quality of capital. So the emphasis should be placed on the common equity tier 1 capital, CET1, which is the strongest capital, as it is permanent also, fully loss absorbing, and provides the highest level of protection during period of stress. The third is also most important thing is they need to conduct regular stress testing. Why? Institutions should carry out periodic stress tests under the adverse scenario, economic like the economic downturn, liquidity stress, deterioration in asset quality, because they have this stress test assess capital adequacy under severe condition so that they can prepare in the future. Another point is optimization of risk-weighted asset, where capital efficiency can be improved by strengthening credit underwriting standard, increasing exposure to secured and retail assets, actively managing portfolio concentration risk. Another important point is monitoring early warning indicators. Continuous monitoring of early warning signals enables timely corrective action. Key indicators includes rising NPA level and rapid growth in risk-weighted assets. They need to monitor continuously. And for NBFC, that should be high. They need to maintain higher capital buffers, given their relatively higher exposure to credit and short-term liquidity risk, as well as greater reliance on market-based funding. Now, the last and foremost important point is adherence to evolving regulatory norms. As you know, that RBI time for the time being or in future also they can change the capital requirements. This is for Basel norms and RBI mandate. So the capitalization framework continues to evolve with this RBI guidelines. It is critical for banks and financial institutions to adopt and strictly adhere to regulatory guidelines, proactively build adequate capital buffers, and strengthening resilience against adverse and stress events. Thank you. Now I'd like to invite Hemant Sagar to give his perspective regarding capitalization.
Well, thank you, Vishal. Thank you for that very good presentation of the capitalization outlook, both for the banks and NBFCs. I hope this was quite engaging for all the participants here. Just to briefly summarize, would like touch upon all the points that he has covered up. He covered up majorly what is capitalization and what is the role that is. So basically, capitalization absorbs losses and it covers up for all the risks like credit risk, operational risk, market risk, liquidity risk. To cover up these, it is a backup. So capitalization to say per se is one of the critical parameters in assessing a financial institution or a bank, and is also an important parameter if you say it's balance or any entity's balance sheet size also. The stronger the capital to withstand itself from any adversities, also adversities pertaining to their own underlying portfolios also. The asset portfolio can go weak at any time. So you have seen the recent stress in MFI. We had brought out our MFI presentation also two quarters ago, and last time when we discussed about the liquidity position also. This is our third session where we are talking about the capitalization, the importance of capitalization, and most important is to have an optimum capitalization. Both over and under capitalization levels are not much go. Well, and it has to be managed with having adequate stress testing been done, especially when the things are going good. You need to have that stress testing done in a scenario where this and what kind of capital infusion or a support could be included in the over a period of time. So, as Vishal rightly said, Tier 1 plus Tier 2 is equal to total capital adequacy. and the tier 1 capital comprises of CET1 and the additional tier 1. So AT1 is generally, these are the instruments which banks go for in case they need further capital to strengthen their tier 1. We had some uh, uh, we had been taking more strength from the tier 1 for the capital adequacy ratio. So overall capital adequacy ratio we require is around, for banks is around 11.5%, that is including the capital conservation buffer of 2.5%. Minimum requirement as per the is 9%. We also have CET1 and Tier 1 ratios to be adhered to. So these are regulatory ratios. The framework has been defined by RBI, especially in a going concern. What we faced crisis during the 2015-16, where the NPA levels had shot of our public sector banks to a higher level. If there was a stronger capitalization levels, that gives a continued support. But RBI not only did that, the government gave a good support to the public sector banks in infusing funds periodically. Also, they have rationalized the banks by doing consolidation and mergers, amalgamations. Few of them are still in lineup over the next few years. So, what overall the government's efforts as well as the RBI's is to strengthen the banking system as well as the NBFC system. So, related to the banking, NBFCs have to maintain a higher capital adequacy ratios of 15% and 10% tier one, CRAR and tier one. So, that gives a more stable environment. As of now, where NBFCs mostly are into short-term loans or term loan facilities, working capital also is a note which is under RBI's draft, which is they are looking at. And as we have already covered up, the capitalization also helps you in getting better ROEs, better NIMs, better ROEs as well. If you have an overcapitalization, your ROEs definitely will go down because you have a higher capital with no resources or no users of them. So we have we know a lot of companies, they have excess capital but don't know how to. So right team and right people and right market to enter and relieve of themselves of any kind of stress on the capital. So CRA, as a CRA, we do look into all these factors. We determine the strong capital adequacy ratio and the weak capital adequacy ratios, which Vishal has already explained. And this is how most of the rating agencies or even ours also looks into it. So thanks a lot, members, for being here, for participating in this event. We would like to have go forward to the next question and answer sessions. If you have any, please shoot it down. Thanks.
Thank you all.
Comments.
Okay. So we have a first question where it says, when it comes to government support, to what degree does too big to fail factors play in? Thanks, Jacob, for your question on when it comes to government support. Is this the first question?
There are a few more.
Yeah, Jacob has actually asked the first question is, what is your advice on optimal capital should be set for IRRPP? Well, there is no specific term which is defined as optimal. If we take in the current scenario for NBFCs, we are looking at around 20% because it is already at 15% as the capital adequacy. Anything about 25% and all gives a further strength. It all depends upon your underlying portfolio and the underlying portfolio which is covered for it, the underwriting for processes that are following and the management team. So that way it is covering for their optimal capital utilization. And the views on the regulatory uncertainty around AT1 post Credit Suisse. Could AT1 absorb losses before CET1? Well, that we have already seen that the concerns on that. Hence, we don't see more smaller banks able to access the AT1 banks, but the stronger banks have shown that and are fairly taking it up. We have seen most of the public sector banks presently having a stronger capital and also the capital support from the government, which gives you that AT1 support for it. Banks and NBFCs has different requirements. Can this lead to an arbitrage between the two types of companies? Well, these two entities, if they were having any concern, had their requirements. Yes, there are different requirements, and whether it should be arbitrage between the two types of companies. Well, these systems are are in the system because NBFC has a specific role or critical role while banks also have their own roles. So they both will go simultaneously together and complement each other instead of arbitraging on either of this. Well, and at the end, it is the borrowers who's the best choice, who's the best to select which entities to go through the NBFC or the banks. When it comes to the government, sir, to what degree does too big to fail factors play in? Well, government support, you have already seen government support has been there for all banks. Recent times, we've also seen amalgamations happening if they are if they see the concerns to because government support has already been there for the last 5-10 years. They have been funding, pumping in support for all the public sector banks. They have even rationalized some of the banks by amalgamation. So government would like to do it once, but once they're set up, they have to take it forward. Prajwal, Surabhi. Surabhi, thank you for this thought. Wonderful and insightful session on market and role of capitalization in pattern. Prajwal has any queries? In situations where a bank's ICAP, ILAP assessment indicates a need for additional capital under stress scenario, and the RBI through SREP directs the bank to strengthen capital buffers, how do CRAs typically incorporate such supervisory shortfalls into the rating analysis? For example, does the need to raise capital due to ICAP, ILAP constraints directly influence the bank solvency scoring, or just the forward-looking risk assessment in the rating methodology? Well, thanks, Prajur, for that question. You're right that we have to look. So, the CRAs always look on a forward-looking basis. The rating is just an indication over the next few months or the next few year how these companies or the bank's status in terms of capitalization will be helpful. So, as a bank or as an NBFC, I know my underlying portfolio. We understand underlying portfolio is going under which stress. So, who are his borrowers, and his borrowers are into which segments? If those segments or those industries are into stress, definitely our underlying portfolio would also see a stress in the near term. Once that near-term stress comes in, and then we try to infuse capital, that would not be an ideal situation. So we know our underlying book, and that's how proactively both NBFCs and banks do their assessment uh, in in generating further capital. Thank you all. She covered all questions.